Let's get more with Stephen Nash from FIG Securities, joining us from the camera there in Sydney. Morning to you, Stephen. The retail sales out yesterday. How do you read that in the whole scheme of, margins, and even with Woolworths, for instance, and its downgrade? First time it's done that in so many years now, 19 no less. How do you see it stacking up?
Well, prior to the floods, we had this difference between the mining and non-mining sector, and we were already concerned about the plight of the consumer generally. And I think retail sales generally confirm that there's a caution out there with the consumer. We've already seen some comments from the RBA on this. I think it's an important theme that's starting to develop with the RBA.
I guess the question is and it was raised by an Arab Bank report that Cass and I mentioned yesterday, what happens if spending doesn't pick up from this point on? We keep on saying, well, when spending picks up, this will happen. But if it doesn't pick up, what does the RBA do then?
Well, I imagine at this stage the RBA is still on a slight tightening bias, but if we have continued depressed levels of spending, I think the RBA may look at taking that tightening bias away. I think without any move by the RBA, we'll have higher bank rates by the end of the year. Probably by mid-year, I'd imagine that there'll be some move by the banks to increase mortgage rates. So that will, I suppose, further impact the economy. Now, we've got this divergence between the mining and non-mining sector. I think there's another fracture coming in now. It's between the Queensland or the flood-affected states and the non-flood-affected states, and the fiscal contraction that's occurring is affecting these, will affect these non-flood-affected states, and even within the flood-affected states, there'll be an impact as well. So we've got this fiscal contraction as well as a possible increase by the major banks coming up. So the prospects for further reductions in consumer sentiment are probably, or consumer spending are probably there. Yeah.
That fiscal contraction in the non-flood affected states, catalysts for that to be occurring? What are you pointing to there?
Well, in order to fund the reconstruction, the federal government has to reduce spending, and that's what they're doing. There's also the Yazzie impact now, so there'll be even more cuts to federal spending in order to fund that reconstruction. In addition, we've got the flood levy, which is a highly contentious issue as well. Yeah.
Okay, well, that's playing out, of course, in the fullness of time. Let's also just reflect a little bit about how that feeds into jobs, because you could argue that the offset to all of what you've just said there is strength in the labour market, near full employment. You don't see that counters that other contraction?
Well, to some extent, and people keep on saying this, the labour market's a bit of a lagging indicator. I think this is the tail end of what has occurred over the last few years. Going forward, I think, is what the RBA is focusing on, and I think within the Statement of Monetary Policy there was that further elaboration of what's going on with the consumer and why the consumer is so cautious at the moment. I think that is something that's concerning the RBA, and I think it will be developed going forward.
What indicators? I was just wondering if you're getting indicators across things outside of retail sales, which is obviously yesterday, in terms of the weakness in the household sector.
Well, I suppose, generally you can look at indicators like auction clearance rates are remaining weak. There's quite a few other indicators out there that you can look at. The picture has been painted by others previously that the non-mining sector is not exactly strong, and if anything, tending to on the weak side.
It's interesting though. We always used to say that vehicle sales were a very good barometer of the health of the broader economy, and they had a solid year end. If you look at that one, they're not included in the retail sales snapshot that we got yesterday. Neither health services, neither education, core items for everyday consumers are not captured in those numbers from yesterday.
Yeah, there's also the aspect of discounting within the retail sales numbers, and one could argue that there was a lot of discounting, and that reduced the retail sales number as a result. So I think you've got to add this to the broader picture, and I think the broader picture, and there's a bit of consensus on this, is that the non-mining sector is stable to a little bit on the weak side and needs to be carefully monitored at this stage.
What about the fiscal side of things? You mentioned the fiscal tightening earlier, but how does that play into now the RBA?
Well, I think that in terms of the statement, there wasn't much discussion about how the funding of reconstruction. I think this is an important issue. The flood levy was mentioned by one of the members and of the board in the press prior to the statement, and it seems like the flood levy is a bit of a dirty word at the moment and it can't be mentioned, but I think it's an important aspect going forward. And obviously we're in this transition phase between private and public, between the public sector stimulating growth and the private sector taking over. What McGivern was worried about was the effect that this fiscal tightening will have on that, and I think that's what the RBA will be focusing on the next few months.
Speaking of central bank, can we just go offshore with this for a moment, because it caught my eye that the dovish comments around what's happening in Europe, where things are still simmering. No doubt you're across this as well, Stephen. Much more dovish tone to Jean-Claude Trichet's latest announcement, and tying it all back to Germany, Europe's largest economy, where some numbers there were not as strong as expected. Are you concerned that that could be a slight chink, a slight crack opening up?
I think the problem for the ECB is that tightening right now will basically tip a lot of these peripheral countries over the edge in terms of growth. They're already looking at very weak growth. Any tightening right now is probably not the right move in order to maintain European stability. I just think it's led by mainly a rise in commodity prices, which are really a function of expectations of growth. So it really depends on what the fundamental growth is in Europe, and at this stage it's quite flat.
How does that compare with the US and the strategy of the Fed? Obviously the market's expecting some sort of rate rise by the end of the year, but they're not talking along those lines at all.
Well, if you're referring to the market being investment bankers, the investment bankers have been talking of rate rises by the Fed incessantly for the last 2 years, and it hasn't happened. The Fed keep on telling us that there's so much spare capacity out there that they're not concerned about inflation. I don't know how many times Bernanke's got to say it, but they're not concerned about inflation with spare capacity as large as it is at the moment, and with increases in productivity being as large as they are. So I think inflation's really is really not an issue, although the bond market is concerned, I think, about a supply of treasuries, and I think eventually that concern will be attended to by Obama, and that's happening right now.
Those yields back now at levels that they hit in May. Certainly a big auction of about 72 billion going through the system this week. Interesting to see how that's received, what happens to yields on the back of it. Many thanks to you.
Thanks very much.
Stephen Nash.